Good day, fellow investors. I firmly believe that value investing is the best investment strategy one can have over his or her investing life cycle. And of course, value investing sometimes works better here in the blue and sometimes works the opposite compared to growth stocks here in the red. But if you look at from the last 120 years, on average, value stocks have performed much better than growth stocks. And especially after these growth stock booms and exuberant times, after that, then value stocks outperformed growth stocks. And yes, the Nasdaq did great and did a 10x now over the last 15 years, but that also means that we are now at the peak of the everything bubble. 10x is a huge returns even for the Nasdaq, and especially now, not just over one's life cycle, value investing can be the answer to accumulating wealth long term, no matter what happens with markets. And I will also discuss how value investing makes money even in recessions and crashes. No matter what, you accumulate wealth and you end up better off after whatever is awaiting us in the next 1, 2, 3 investing decades. Now, before going into value investing, let's discuss how we are now into an everything bubble, and that's why we must be very careful with our investments. Because when it comes to value investing, risk comes first. So we first look at what can go wrong and then at what can go right. As would Charlie Munger say, everyone is trying to be smart. We as value investors just try not to be stupid, and then we look at how not to lose money compared to how to make a lot of money. Because if you don't lose money, then the returns take care for themselves. And if I look at the S&P 500 dividend yield as of now, which is ridiculously low, then the chances are, if the P ratio of 26 goes to 15, then the chances are for 20 years of zero returns with crashes in between. And therefore, also, if anything reverts to normality interest rates, this is just a great businesses and everything, but too risky at this price, and the money has there already been made. And stocks went up for the last 42 years since 1982, and as I said, we need to avoid doing stupid things, but if we avoid investing in over exuberant indexes for the majority of the time, we look stupid while others are making money. But why did most people make money over the last 40 years is because interest rates just went down for 40 years, from close to 20 to 0. And only in the last year, interest rates went up, but everyone is expecting for those rates to go down again. Plus, when interest rates were at 0, then the government said, let's expand the Fed's balance sheet, let's print money, let's go into debt, let's keep those asset prices as high as possible, which led to this 40x over 42 years, 50x over 42 years. 100 was the S&P 500 index in 82. And now the question is, what will happen over the next 15 years? Will this bubble, will this loose financial environment continue or not? Impossible to predict, I don't know. But I want to invest in a way that whatever happens, I am okay and I end up well off. That is value investing. Because we just had the Fed's not cutting surprise this week, so we don't know whether rates will go like this or like this or like this. So we have to invest in a way so that through our life cycle we do okay, no matter what the rates are. And speaking of the last 15 years, we just had 15 years of great returns. And in history, after great returns come bad returns for a decade or even 2 decades. And that's why one has to be careful when it comes to investing, because As Buffett says, a rising tide lifts all boats, but not until the tide goes out that you realize who is swimming naked. And the question now, when it comes to investing and going forward, is, are you swimming naked? And if you don't want to swim naked, then you have to accept value investing as a lifestyle of investing, no matter what happens with the market. So over these times, especially these 17 years after an exuberant run, in this book, The Case for Long-Term Value Investing, they show how value investments, I calculated here, I extracted the data from the book, in 15 years, value investing did 11x, while growth investing did 3.6x. That's a huge difference for times of high inflation. I think there were 4 recessions in that period, which could be something that awaits us going forward. And this difference is a huge difference when you invest, so practically 12% value investing versus 6%. Of course, this is a linear investment, but when it comes to retirement, there is a huge difference between having $1 million or 300,000. Of course, we cannot know what will happen with rates and everything, but we can know what is going on with the businesses we own, the risks related, the stock prices we are paying to own those businesses, which is the essence of investing. And now, as I said, I don't know what's going to happen going forward. If just things continue like those are, growth stocks will keep giving you the 10%, and if you focus on value, you will also likely get the 10%. Nothing wrong there. But if bad times come, growth might give you negative 5%, value might give you positive 5%, and that's a huge difference. Public debt has exploded going forward. The solution to that is usually inflation. It is not going away. So we will see. But as Jim Rogers used to say, the next 15 years will likely be completely different than the past 15 years. And we now enjoyed 15 years of practically zero interest rates. Before that, we had higher interest rates. Now, it might be time for higher interest rates for longer. It can happen, but that will have a huge impact if you're invested in risky assets. And real investing is boring, and it's not exciting. It's not something to watch YouTube videos about. Let me just explain. Let's just say you own an apartment building in New York next to a university, and you are netting $20,000 per month, or you're getting $20,000 per month from your dividends in stocks or whatever. Do you care what the Fed does with interest rates? Do you run out and sell your apartments because the Fed will not lower interest rates? Or do you just enjoy that 20,000? If there is a little bit of inflation, you increase rents and you go to 25,000, like businesses do. So that is really real investing, but it's not exciting. The key is just to own a lot of businesses. As you own apartments, you might own businesses, and that's about it. That's the whole mystery there. How much you pay, the lower you pay for a good business, the higher will be your yield. You reinvest, you compound, allow for compounding if you don't take crazy risks, and that's about it. You focus on owning more of the businesses that fit your requirements. For some, it is apartments. For some, it is food businesses like ADM that has been increasing the dividend for 90 years. And it is much better to buy it now when the dividend yield is 3.5% than a month ago when it was 2%. And now, on how to make real money value investing even in crashes, even in recessions, well, let me give you an example of how you make money in recessions and crashes. Let's say you have $2,016 to invest and you buy ADM stock at $56, you buy 36 shares. That means that at $2 per share, you get $72 per year. Now, if the stock crashes from 56 to, let's say, 36, you can buy 2 shares in place of the current 1.3 share. 2 shares increase your ownership, increase your wealth, and that is how you make money. You make more wealth when the market crashes. That is the essence of value investing. Plus, most of us invest monthly, thus from your salary, from your income, you add monthly to your portfolios, which again means if prices are lower, if crashes are there, you're more excited because you can buy more, own more, and that is the ultimate measure of your wealth. Not a million in stocks or 500,000 in stocks, 1% of, I don't know, the American economy, or 2% of the American economy. Depends on what you own, that's how you become wealthy. And of course, now you can buy one share of the US economy at $5,000. Just a few years ago, you could buy 7.3 shares of the economy with $5,000. That, for me, is investing. And as Warren Buffett says when Jeff Bezos asked him, everyone understands that it's so simple, why doesn't everyone do it? Well, nobody does it because nobody wants to get rich slow. And that is the essence of investing. Give it 20 years and you'll be rich. And that's exactly what I'll be doing over the next 20 years. Check my research platform to follow. I'll see you in the next video.